On the morning of July 8, 2025, U.S. President Donald Trump signed a sweeping executive order that could mark a pivotal shift in global trade relations. The directive imposes new import tariffs on 14 countries, with tariff rates ranging from 25% to 40%, and is set to go into effect on August 1, 2025. A nearly one-month extension from the previously speculated July 9th deadline. This aggressive policy move is part of the Trump administration's continued protectionist strategy aimed at reshaping America's global trade position, but it also risks reigniting a multi-front trade war, destabilizing international markets, adding new layers of complexity to an already fragile economic environment. Let's unpack the implications sector by sector, economy by economy, and what this might mean for the crypto markets and investors looking for safe harbor in digital assets like Bitcoin and Ethereum. According to the official announcement, affected nations and tariff rates are as follows: 25% tariff, Japan; South Korea, Malaysia, Tunisia, Kazakhstan, 30% tariff; Bosnia, South Africa; Herzegovina, 32% tariff; Indonesia, 36% tariff; Cambodia; Thailand, 40% tariff; Myanmar; Laos. Latest round of tariffs is targeted at key industries in each country, ranging from automobiles, electronics, and telecommunications to textiles, machinery, and raw materials. Japan and South Korea, two of America's most important allies and trading partners, have already signaled concern. South Korean tech and telecom stocks reacted immediately. SK Telecom plunged 7.5%. Japanese automakers were also hit hard. Toyota and Honda shares dropped 4.1% and 3.8%. Respectively. This isn't just a trade maneuver, it's a global signal. This move is not isolated. It reflects a broader return to America First economic nationalism, a cornerstone of Trump's trade policy during his first term. His administration argues that these tariffs are necessary to offset chronic trade deficits and counter what it deems unfair trade practices, especially in sectors like EV manufacturing, semiconductors, and consumer electronics. According to the White House press briefing, these tariffs are essential to protect American jobs, rebuild domestic manufacturing, and defend national economic sovereignty. The administration is also leveraging tariff threats as a negotiating tactic, signaling that any retaliatory measures from these countries could trigger further escalation. President Trump was blunt. If Japan retaliates, we'll raise tariffs even higher. This is about American workers, American industry, and America's future. Experts are already warning that the decision could ignite a new wave of geopolitical friction, particularly in Asia and emerging markets. Countries like Japan, South Korea, Thailand are heavily integrated into global supply chains, especially in high-tech and manufacturing sectors. According to analysts at the Peterson Institute for International Economics, this level of tariff aggression invites retaliation, fractures alliances, and adds uncertainty for multinational corporations operating in Asia. The World Trade Organization, WTO, is expected to review the legality of the measures, especially since several affected nations have bilateral and multilateral agreements with the U.S. under the WTO work framework. The IMF issued a cautious statement, expressing concerns about global demand and urging diplomatic dialogue. Economists worry this move may compound inflationary pressures and slow international trade. At a time when the global economy is just beginning to stabilize from prior disruptions, as news of the tariffs broke, the U.S. stock market opened lower, with the Dow Jones Industrial Average falling 0.8%, led by declines in industrials, automakers, and tech companies with exposure to Asian markets. Asian markets were hit harder. The Nikkei 225 fell over 2%. South Korea's Kospi dropped by 1.7%. This movement reflects investor concern over supply chain disruptions, rising costs for raw materials, and potential export slowdowns. Industries particularly vulnerable include automotive, semiconductors, and consumer electronics are critical to the global economy. Interestingly, while traditional markets wavered, Bitcoin and XRP showed divergent behaviors. Bitcoin BTC briefly dipped below $108,000, reflecting broader market nervousness. Before stabilizing, XRP Ripple defied the trend and posted a 2% gain. Largely due to positive news around tokenization and international payments, this divergence highlights how crypto markets are increasingly decoupled from traditional risk assets during specific events, particularly as they become more integrated into cross-border finance and monetary policy. Alternatives. One of the most notable stories of the day was the announcement that Mercado Bitcoin, Brazil's largest crypto exchange, tokenized $200 million in bonds and stocks on the XRP ledger. XRPL. This follows their previous tokenization of $185 million in private credit, with Ripple payments now enabling fast and efficient cross-border transactions between Brazil and Portugal. XRP is increasingly seen as a bridge currency, a real-world application gaining momentum amid broader crypto adoption. This momentum pushed XRP higher, even as other major altcoins saw modest declines. As tokenization becomes a mainstream financial strategy, networks like XRPL stand to benefit from global trade tensions and shifting capital flows. Ethereum also made headlines this week. Vitalik Buterin and Tony Worcester proposed EIP 7983, which introduces a gas limit per transaction currently not enforced. This change aims to reduce the network's vulnerability to certain types of attacks and increase stability. The proposal suggests a transaction gas ceiling of 16.77 million, compared to the current 36 million per block. This technical adjustment, while still under review, is a crucial step in Ethereum's long-term resilience and scalability, a signal that the network is actively evolving in response to real-world challenges. At the same time, Bitcoin funds remain bullish. Investment firm Strategy announced it would sell $4.2 billion worth of STRD shares to buy more BTC and distribute dividends, doubling down on the narrative that Bitcoin is the safe haven asset in times of geopolitical uncertainty. The introduction of tariffs on 14 countries represents more than just a trade recalibration. It reflects a new era of economic bifurcation, where globalization gives way to regional alliances, capital controls, and protectionist competition. In this climate, investors should be watching several key trends. Volatility in traditional markets is likely to increase, especially in automotive, electronics, and import-reliant sectors. Safe haven demand for crypto especially. Bitcoin could intensify as macro uncertainty rises. Tokenization platforms like XRPL will attract attention as capital seeks borderless, censorship-resistant settlement rails. Ethereum's upcoming scalability updates may help ETH regain traction as an institutional-grade network. Altcoin narratives like Solana's, Dupian, Paleo, AIS, Edo, and new DEX funding like Karu's $11.5 million Series A show that Web3 innovation is accelerating despite macro headwinds. President. Latest executive order is not a one-off event, it's a structural shift. The tariffs signal a hard turn away from global cooperation and toward strategic decoupling, forcing investors, corporations, and governments to recalibrate their assumptions about global trade, finance, and supply chains. For crypto investors, this may actually be a bullish inflection point. As traditional markets react to policy shocks, blockchain-based systems continue to operate with transparency, immutability, and resilience. Whether you're in stocks, bonds, or Bitcoin, the world is changing fast. What's happening today will shape trade, technology, and trust for years to come. And in that shift, crypto is no longer just an alternative, it's becoming the hedge.